Hello, welcome back. I'm making this video in an effort to help new investors and people who want to learn how to analyze some of the fundamentals of a company. And this is going to be basically 10 tips that can help you understand whether a company is a potential good purchase, a good buy, or not. And what we are doing here with these metrics is we are actually evaluating a company's financials in terms of what the company is doing with money, how much money they're making, how much debt they have, how much they are growing their operations, and all sorts of similar things. And you can have a baseline of like 10 things that can give you a very good idea of what the company is about. To start off, one of the very well known metrics and widely used is the PE, is the price to earnings ratio. It's basically a ratio between the current price of the stock, the current market price, and the earnings of the company for the current year. And that is price per share divided by earnings per share. So this is adapted per share, really. Usually you want to be seeing a value that's around 20 to 25x over here. For a company to be kind of normally valued, or if it's less than that, it's typically undervalued. Now, that said, the higher the growth of a company, the more of a multiple, the higher of a multiple you may be willing to pay. So you may be okay with going 30x. And also vice versa. If you're buying a company that doesn't enjoy growth right now, you actually want to be getting it at a lower price to earnings ratio, maybe even a 10 to 15. It really depends on the company, really. And this is a very useful baseline in order to quickly have an idea on whether the company is kind of overpriced based on how much money they're making. So this is the first one that I'm going to be taking a look at when I'm investing into a company. The other one that I'm going to be taking a look at is the price to book ratio. And let me find it here for you. Okay, so here you can see the price to book ratio for NVIDIA, starting from 2018 till the last 12 months really. And you'll notice that it used to be 17.6, then 10, 13.6, 21, and 26.5, currently sitting at its highest really. And so with the price to book ratio, you again want to see as low of a value as possible here, because this means that you are actually paying less for the amount of book that you're getting. And book, what we mean by book is basically the assets of a company. Assets of the company can actually be the cash that the company has, equipment, buildings, everything that the company really has. And so if you're getting a lower price for a higher book, you can understand that the lower this value is, the better it is for your money, the more undervalued the company is. And so over here, you're looking at a company that is overvalued in terms of its price to book, and it keeps growing higher and higher. So next one we're going to be taking a look at is the price to free cash flow, which is a little bit more indicative just because the actual price to earnings, which we examined earlier, kind of creates a ratio between the price of the company and the earnings of the company. But the price to free cash flow is a little bit more inclusive because it excludes a little bit more exclusive because it excludes the capital expenditures of a company when you are calculating that. Because free cash flow is the operating income that the company makes minus the capital expenditures that the company has. And so you're getting a cleaner picture by examining the free cash flow, because there are tricks that the company can play with the income, with earnings really. And so you can use this as a more reliable way of validating a company's financials and examine whether they are overpriced or not. And so the first thing we need to be taking a look at when we're examining the free cash flow is the current market cap of the company, which is sitting at $630 billion almost. And you will notice here that based on the free cash flow on average, let's just say, to make it easier, that the company is making about $5 billion in the last 5 years on average again. Now, if we get this value of $5 billion and we give it a multiple of, let's just say 30, what are we getting if we multiply these values together? We're getting 150, right? 30 of a multiple multiplied by $5 billion of free cash flow every year. So we're getting $150 billion of expected market cap for the company if we give it a multiple of 30, that is. And so here we're having a market cap which is $631 billion. So it's much more. It's almost 4 times as much, actually more than 4 times what we calculated here. So we're having a multiple which is probably about more than 100 really here. So this is a very quick way to actually analyze whether the price to free cash flow of a company is overbloated, or it's actually less that you would expect. So if you get a multiple for this kind of company, which is a tech company growing nicely, a multiple of 25 or 20 or less than that, then you're looking at a potentially interesting opportunity that can make you money in the future. But if you are getting a very, very inflated value here, then you may be in for some trouble in the future, just because the company is very, very overvalued based on the free cash flow that it's making, again, based on this ratio. So the next thing we're going to be taking a look at, we're going to be going back at the overview of the company really here, and we're going to take a look at the outstanding shares, sitting at $2.5 billion shares here. And so what we want to see here is how the company has been acting in terms of buying back shares or actually issuing more shares. Why that is? Because if you were an investor, let's say here in 2012, and you bought some stock, then the company, you notice that actually bought back shares. This is why the actual outstanding shares count is decreasing. And so the company actually bought shares back, which means that the supply of the stock went down. And so if you were holding, let's say, one share, the supply was, let's just say, 100 shares here. So you were holding 1% of the company. But as the company kept on buying, then at some point it bought, let's say, 50 shares back. And so now you're holding 100, you're holding 2% of that company, which is 1 out of 50. So the more shares the company buys back, the better it is for investors. But here, the company actually started actually issuing more shares. And that likely happened because the price went up. And so they wanted to get some back out of that trend, really. So they wanted to sell it because they thought it's expensive, and it probably is. So they wanted to fund operations with selling the stock instead of actually getting debt. So that's an interesting way to know whether the company is actually diluting investors, as we're calling this situation here, or it's actually helping investors by buying back shares, thinking that their current share price is actually cheap even. So the next one, we're going to be taking a look at the debt to book ratio here. And so here it is, the debt to book ratio, or debt to equity is the same thing. What this means really is how much debt we have when we compare it to the equity of the company. And so if it's 50%, that means we have $1 of debt for every $2 of equity, almost. It's 50%. If it was 100%, it would mean that for every $1 of debt we have $1 of equity. And so as you can understand, the lower this value is, the better it is for the company in terms of debt. Now, we don't really want a company that has zero debt, because debt can be a very, very nice and powerful tool for growing a company. And so companies that have like 30% or 20% or maybe even a little bit more in some situations are totally fine and could be very, very solvent and have no issues really with in terms of debt. And so you should be taking a little bit of a closer look at this one and examine whether companies have like 200% or 100% or more than 100%. This is when things can get a little bit dire for the company in the near future, really. This is a very, very interesting way to know about this. Another very useful way and quick and simple way to actually determine whether a company has enough cash flow to pay back debt is you can take a look at the balance sheet of the company and look at the current total liabilities. The total liabilities of the company include the long-term liabilities and the short-term liabilities. So it's the total. Currently sitting at almost $17 billion here. And now what you can do is take a look at the cash flow of the company, see how much they are making every year. So here they made $7 billion. If they're making $7 billion and the total liabilities were like 17, right? 17 billion. That means that if they allocate their total free cash flow for less than 3 years, they can actually pay back the whole debt that they are actually having here in terms of their total liabilities. This is a very, very quick way to evaluate that. And if you find companies that have a value of less than like 5, which is like less than 5 years, this is typically a very, very good thing, and the less, the better, of course. And so in this situation, you're looking at a company that doesn't really have any issues with debt currently, and probably won't have issues in the very near future, really. So let's go to the next one. The next one, we're going to be taking a look at whether their actual revenue and net income is increasing, and same thing with cash flow. So what we want to be doing here is we want to be going back at the revenues of the company and examine whether it's actually going up or down. So you'll see here that it used to be $9 billion in 2018, and it has grown nicely. And you can find some years where it's like a little bit less. That's not a big deal. But you will see here that typically the year-over-year growth is massive, and the company has reached $24 billion. So that's a very positive sign here. And same thing that we want to be doing with net income, which is the bottom line, really. 3 billion for, again, a little bit of a drop here, but overall it's going up, and 4.3, 8.2. So that's great to see. And the same thing we want to be doing with the cash flow of the company. Examine whether it's been going up, and you'll see that's the case here. And also the balance sheet of the company. Examine whether the total equity of the company is going down, which means that they're not spending equity to fund some of their debt, for example. So this is a very, very important way to discover whether the company is actually making money over the years, and we want to be doing that. We want to be examining these values and this kind of growth. Next up, if the company is paying dividends, we want to examine whether the dividend is sustainable. So in this situation, the Nvidia Corporation is paying 0.06, which is a very, very low dividend, obviously. But what you want to be examining here is two things. The dividend history of the company. So typically, the more years the company has been increasing its debt, the better it is. But we also want to be examining the payout ratio, which is very important because it gives you an estimate on how much money the company has in order to pay its dividend. And so 4% is what they're paying out of their out of what they are making here. So this is almost nothing. And typically, if you're finding companies that have less than 50% of a payout ratio, this is really good for you because you know that the dividend is potentially sustainable and probably sustainable, really. Myself, I'm not really a huge fan of dividends because they can really stall the growth, and they are not very efficient in terms of taxes. But if you're interested in getting some income, then you should definitely be taking a look at this ratio here just to make sure that it is sustainable. The other thing that you want to be doing is actually taking a look at some competitors of the company, taking a look at what the competitors of Nvidia are doing. And you can open up all sorts of companies that are competing with Nvidia and are being in the semiconductors industry and examine them in detail as well, see what are the differences between Nvidia and them, and whether Nvidia has better numbers in terms of a PE, for example, and whether Nvidia is better in terms of a price to book ratio, and kind of compare and contrast them, see which one makes the most sense for you based on what they are currently making and what their ratios are. And you can do that and have them analyzed side by side. You can do it with like 5 competitors, like the 5 top competitors of the industry, for example. That's a very, very useful thing to do in order to determine whether the company is worth it, again, compared with the competitors, which is very, very important. Next up, we can take a look at some of the ratios here, like some very, very interesting ratios. And one that I like to use is the enterprise value to sales ratio, which enterprise value is, as you can see here, the market cap is $631 billion. But if you take a look at the enterprise value, this also includes some things like the total debt and the cash and short-term investment. So it kind of evaluates debt as well and some short-term investment and cash here to remake the enterprise value of the company, which is very, very similar to market cap. It just includes this kind of things here, like the preferred equity as well and minority interest. Kind of gives you a better picture, really. And so this contrasts that with the sales of the company. And so as you can expect, you want more sales for a lesser enterprise value. You want to be selling more for the, when you contrast the sales to the enterprise value of the company. So you want a lower value. Typically speaking, 1x to 3x is what you should be looking for if you're trying to get cheap value. But over here, you're looking at a company that gets increasing, apart from 2019, increasing EV to sales ratios. And so this points to a company that is pretty expensive for the amount of sales that they're making here. So this is another way to actually evaluate whether a company is actually overpriced or underpriced. I mean, the company could still be doing awesome, but the point is we want to be getting it at a fair valuation, at a fair price for our money, because we want to and need to be making money back out of our investment, right? And some of the last things that you could be also taking a look at is the profitability, some of the profitability metrics here. Like for instance, the return on equity is very, very interesting. And obviously, the higher the value this has, the better it is for an investor, because you are looking at getting a higher return on the money invested for the company. And this is obviously pretty high here, and it looks like it's getting even higher. Now you need to bear in mind that sometimes this can be skewed by debt that the company has, although Nvidia doesn't look like it's having too much debt. But still, bear that in mind. This can be kind of changed logistically with some accounting tricks here, really, and point to a very, very high return on equity that's a little bit not true, really. And also, you could be taking a little bit of a closer look at the gross profit margins, see how the company is increasing its margins or keeping them the same. These are some more some margins here, for example. But yeah, that's what I wanted to point out in terms of some quick tips and tricks for evaluating a stock and a company, really, which is basically what you are evaluating. The stock is just a product of the company. And there's two things that you need to bear in mind. It's always about what the company is making and how well they are doing financially. And you have to contrast that with the current price of the stock, because you're entering a company for a valuation. And so you need to be entering a company when it's cheap and not expensive, if you want to be making money into the future, or at least have a better chance of making money into the future, because pretty much every investment is about how much the company is making in the very end, minus what is spending for debt and all the operations and everything. So this is what it comes down to, and we're using all these values to quickly evaluate whether it's a potentially interesting investment to pick a company over another one. So this is what you need to be examining. All these values can really, really help you identify whether you picked the right investment or not. Hope that helped you a little bit. And if this video was interesting to you and kind of gave you some ideas, please leave a like and subscribe to the channel, because that really helps a lot. And I'd love to see you around. We have a Discord channel for this YouTube channel. We're discussing all sorts of things investing. We have already like 15 people in our channel, in our Discord channel, and we'd love to have you there. So join us. You can find the link in the description box below. And if you enjoyed this video, take a look at this one that I made a little bit earlier. It's about Facebook. Looks like it's crumbling a little bit. So thanks for watching, and I'll see you in the next one. Bye bye.